You see around yourselves, okay, this is the exact number of people that actually stays in the fight to make money. Okay, all those who have left will be leaving in that journey as well. So I flew from Mumbai, okay, and I asked a lot of Bangalore people that what do you want to do? Someone said they are building skill tech, someone said they are building ed tech, someone said they are building something into agentic AI. What's interesting is I asked them after what, and what will you do after that? Do you have a plan to make money? They said, no, we'll be unicorn. No. I'll tell you what happens. I traveling here, you sitting here, this event, people running down the streets, everything boils down to money. That is what we are doing things for. Now, building a startup doesn't makes you money. Struggling day and night doesn't makes you money. Doing everything that you can doesn't makes you money. It is the plan of exiting, plan of getting acquired by someone more powerful than you, plan of making sure what you built is a legacy for you, is what makes the money. And that is what we are going to discuss today. I actually know a very good news channel who is doing great on YouTube and all. Okay, 100% you have seen that channel. When I talk to his founder, no, he's like, I am building to sell it to the Ambanis. I want to sell this news channel to Network 18. And he started after COVID. Now, as of today, he is in that radar where Network 18 in a year or so will acquire them. And he is very sure that this is what he wants to do. He wants to build businesses, flip it, make sure it gets acquired, make sure it gets IPO, make sure they get the exit that they are looking for. This is the only thing that makes money. Nothing else makes money. You should know where to exit and how to make money. This is the discussion that we'll be having today. And with this, I invite our three panelists. First is Mr. Pankaj Jain from Kaizen Capital Advisors. Hi, Mr. Pankaj.
Thank you.
Welcome. Second is Sreepriya from Interest Family Office. Hi, Sreepriya. Looking young than ever before. Please. Then third is Sinchana from Warm Up Ventures. Hi. Thank you. So we start with the discussion that when exactly what should happen. But before we do, I would like each of them to be their own speaker. Please, you are free. You are free to introduce yourselves the best way you can.
Hi, I'm Sreepriya. We run a multi-family office. I'm sure family office is not a new word for all of you who are here in the startup ecosystem. So most important, we do have something called CFO service, where we work very closely with the startups founders. So the whole firm works with founders from startup to scale up to exit and beyond. So that's what we are. Thank you.
Hi, Pankaj Jain. My road to entrepreneurship was slightly different. I made some money, lost some money, and when I realized I lost more money than what I had made, I moved to corporate. Kaizen Capital does a lot of work in the sports ecosystem. We also are a specialist boutique investment bank and financial advisory firm.
Hi everyone. Is this audible? Okay. So hi everyone, I'm Sinchana. I am currently working as an associate at an early stage fund called Warm Up Ventures, and we back bold founders on day zero. Prior to this, I've had experience working as an investment banker as well. So I have had a very unconventional path to coming into finance post my engineering. This is me.
So thank you, Sreepriya. Thank you, Pankaj. Thank you, Sinchana. They have great profiles. Now let's say this is the people that are left. I'll start with Pankaj. Pankaj, what do you think? When I talk about founders exit or founders leaving what they built, let's start what MS Dhoni did. he was playing very well. Still, he retired from T20. Or it should be like Sehwag. He had that peak and that downfall before he retired. So when does a founder identifies that I'm just getting started or this is my peak? Is there any criteria? What do you think? Please set the base for us.
I mean, one, Dhoni retired from international cricket, but CSK still wanted him for years and years. Tells you about his own brand and longevity of his, the aura, the sheer aura that he commanded. Having, seen a whole host of entrepreneurs from first time fundraising initiatives to unicorns, entrepreneurs tend to be a different breed. And, having also been on the other side of some of these largest insolvency engagements in the country, when to stop and when to move on is something that you can't, educate an Indian entrepreneur. I think the genes and the blood want to get to the next scale, get to the next Everest. And, if you look at maybe an Anil Agarwal of Vedanta, you look at JSW over the last 10 years, they've expanded from their core businesses into steel and cement, and they've also forayed into sports, etc. So, when to stop, when to tell an entrepreneur to stop is probably the most difficult discussion that one could have in the boardroom.
Thank you. Still, let's move on to Sinchana. Sinchana, do you have any cue, let's say industry-wise, if a founder reaches this much capital or this much valuation, this is the right time generally in the market to exit from that particular industry? You can choose your own industry to answer.
So yeah, like Sir mentioned, it's very, very, very circumstantial and it depends on company to company, sector to sector and founder to founder. But to give you a basic range, some of the most hot topics in the market today is in defense tech. We've all been watching what's happening in the geopolitics scenario today. So with that, Indian defense has been very, very active and we want to indigenize all the production, be it AI models that we were maybe using other models before. Now we are moving towards more and more towards sovereign AI. Apart from that, we're moving more towards indigenizing all the micro components of drones and other important components as well. Saying that in 2024, our defense TAM was sitting at around $15 billion. But today, if you just look at the defense electronic components as a market, that in itself is a $24 billion market. That's a huge jump that we see in a particular sector. So saying that, we have seen a couple of good IPOs in the recent past with IdeaForge and others, and a lot of other companies which are in Series C and growth stages. But the IPO or any exit in a defense would essentially not come from an ARR multiple. For a SaaS company, maybe around sitting at a $10 million ARR is a very good place to exit, but not for a defense tech company. For a defense tech company, the valuation would be more on the multiples of the IPs that they've created over the years, or maybe a strategic buyout with the larger firms like L&T and other OEMs. So that, I think, is a buyout play here. But saying that, all the defense tech opportunity lies in creating our own moats today and not just assembling that we were doing a couple of years ago. So this is one of the very hot sectors that we are seeing. Apart from that, maybe blue collar workforce organizing this. So there are around 450 million unorganized blue collar workers today in India, from carpenters to nurses to others. And Apna and other bigger companies like Better Jobs are doing great jobs in giving them better workforce opportunities, then sending them to other Middle East, Germany and others. So Germany has a very big use case for Indian nurses. And these companies are doing a great job doing that, and that in itself is around $10 billion market today. And here the play for exits would come from maybe mergers and acquisition from a fintech company, because there's an overlap here. So for a fintech company, building a neobank would be difficult, but merging with such a organization that already has built trust among these marginalized community and giving data and access to them would create a much better mode than them building. So these are a couple of them.
Thank you so much, Sinchana. Now, from Sinchana to Sreepriya. Sreepriya, let's say they decided to exit through M&A, through IPO, and they decided the defense tech. What are the most common compliances that are generally overlooked by founders that gives them a back when they go for these exits?
So we have been fortunate as a family office. We work very closely with potentially UHNI families and family offices where they look at investing into startups. One of the most important things which investors look at is the integrity, the governance aspect in these startups. What is the clarity of the founder? What kind of exit he or she has vision for? And again, these are some of the things when they will look at when they are investing. And the same way, while doing the due diligence or while looking for an exit also, the same parameters sometimes can be relooked at. So, for example, when we worked with a company for exploring options to invest, but we saw that there were like some of the statutory payments were unpaid. SOPs were there, but it was hardly followed. So there are many such things which was not in place. So we just walked out. We said, we are not going to invest in such a company. So investment itself is not possible. So again, you will find it difficult in exit or in a strategic buy or a takeover or M&A or any kind of a transaction. So our humble thing whenever we meet startup founders is, please keep your basic hygiene intact. Keep a watch on all the governance aspects. It's extremely important if you're looking at scaling or exiting.
Okay, so governance is the point that Sreepriya told to look out for. Otherwise, you'll be ending up like Byju's. Most probably. Okay. Coming on to Pankaj next. Pankaj, let's pick up a specific scenario. Now, I have my own company, Shinitex Global. Okay. Let's say I get an offer today that I have two options, whether I should invest in private equity or second, there is an option of full strategic buyout. Now, as a founder, how should I evaluate? What are some basic things that I should be looking out for to evaluate whether should I be going for this PE or this strategic buyout?
At any stage, there are various perspectives that play out and there are scenarios. Now, for instance, if my ambition is to still grow the business manyfold and have a better layer of board advisors, etc., I might want to choose the private equity route, and which, not only comes with capital, but would also come with a few connects, maybe a senior board advisor, etc., which helps me to get to the next level. A lot of times I also see in today's day and age that the next gen is particularly not keen on continuing the family legacy and they want to diversify, do other things. In such situations, the promoter and founder usually looks at a strategic buyout. And given these financial inclusiveness and the sophistication that you see in the Indian ecosystem, you also see a whole host of private equity buyout funds. And there have been examples, they've taken majority stakes in companies, the values have increased significantly, and and then they've exited. There was a very prominent US-based VC firm in Rajasthan Royals, and they of course recorded a multi-bagger exit a couple of weeks back. So yeah, I mean, no hard and fast rule here, but in broadly speaking, if I want to stay invested, run the business, take the business to the next level, also look at better operating mechanisms and governance structures, I might just want to dilute minority, stay invested in the business, and continue the growth journey.
Thank you so much, Pankaj. With this, I have one more question to ask to Sreepriya again. Sreepriya, let's say I get this offer of IPO, good IPO exit. Now, how do I ensure my control even after IPO? What should I be doing that makes sure that I rule the board, I rule the table?
Okay, it's a good question. So definitely, like, exit momentum is accelerated in India. I think India is not just creating startups, we also are creating a lot of wealth. And one of the things founders should know is exiting is not just an event. It's going to be again a journey which will have to be continued. So you need to definitely have a plan. After the exit, what are you going to do? Right? How are you going to see how the stewardship is going to happen, be it your business or your personal wealth and your personal affairs, right? So that's extremely important. And now coming to your question, as a founder, if you have listed your company, now if you want to protect your rights and control, there are various mechanisms one can look at. Founders, some of the things which are commonly used are structures like a trust which will have significant ownership, which can be transferred, the ownership in the individual name can be transferred. That helps in ring fencing. In case if there is any kind of a communication gap or a misunderstanding between the investors on the board and the family promoters, a trust structure can help. It also helps in succession aspect. And at the same time, you will still have the control. And another most important beauty of this is that post your company getting listed, there are certain compliance criteria whenever you want to do transaction or you want to take liquidity for yourself. But if it is already in a trust structure, you can probably skip all these compliance process because you don't have to go to the company board for even creating your own liquidity from the stocks which you hold. So that's one. There are families where they create family office structure, very good family office structure before they plan for the exit. So I think overall planning is extremely important. If you do not plan the event, which is, again, it's not an event, I'm telling you, but still, planning for an exit is very important for founders.
Thank you so much, Sreepriya. So the terms that I get out of it largely are ring fencing, trust, structure, and succession formation. Okay. Thank you so much. This is something that everyone should know so that they know how to control their baby after it is out of their hands. Right? Thank you so much. Let's come to Sinchana about this. Sinchana, let's say we get this $1 billion valuation for our startup Unitex, which we'll get surely. Okay. Now, I am sitting on that $1 billion valuation. Before going to IPO, should you recommend going for secondary?
So this has been a very interesting topic and very emerging topic
Please introduce the word secondary also.
Among Indian founders of late. So basically what happens is when you're sitting at a $1 billion valuation, that doesn't mean the founder owns it all. The founder usually owns around 10 to 12% of that stake, of that equity. And that roughly translates to around 1,200 crores. But that is paper money. Now the founder does not own that. And that is creating a lot of loss aversion for him. That means that he cannot take up a lot of bets that maybe he would have taken if his finances were secure. So that is why a new term called secondary has come up in the market. It's there in the market, but now it's become very, very popular. So stats say that around from 2020 to now, we have seen a 60% jump in the secondary sales. Before, we used to think, and it was a negative signal to the market or investors, saying that maybe the founder is not taking enough risk or the founder thinks that the valuation has peaked. But now I think the investors are also coming into a lot of terms, and now they also know that the founder himself has to secure his future too, along with the company's future, and only then he'll be able to take the risks that will impact the company's in a longer view. So secondary is a sale that happens where the founder gives back his equity to a new investor or some existing investor. So that is secondary. So one very famous founder who did this was of First Cry. So just 1 week before First Cry went into IPO, the founder sold about 1.5% of his stake and cashed in about 300 crores. That brought him equity stake to around 5%. Now with this selling of with the getting of 300 crores, he ensured that his financial security is also maintained, thereby also having 5% stake in the company before going into IPO, thereby maintaining his skin in the game as well. So this is a common procedure that's been happening in the market, and me as an investor also would suggest all of the founders, aspiring founders, to think about this while they are in that stage. The ideal sellout percentage should be less than 20% of the whole stake that they have, because if it is more than that, if it is around 50-60%, then again it's a negative signal to the market that the founder is not very serious about the business valuation and IPO. And there are a lot of structures to which you can sell out your stake in the secondary. Maybe sir is a better person to answer all of those structures.
What a clear, beautiful answer. I'll keep it close to my heart if we go for IPO. Okay. Now, over to Pankaj again. Pankaj, let's say there are a lot of businesses who are profitable mid-size. Okay. And they have chances to be acquired or to be merged among the rich businesses, the businesses who are consolidating. So what are few things that you think that mid-sized business should do and the acquirer should be careful about before acquiring those mid-sized businesses? So that we are very aware, if we have this mid-sized profitable business, we know what to do once someone comes for us.
I think a very relevant question. Most of these SME businesses and, mid-market enterprises are typically family run, family owned and family managed, right? And so usual due diligences, your financial due diligence or legal due diligence, and a lot of the market reputation that you see around a business is usually from the financial statements. Now, one needs to maybe take a deeper dive and go beyond the financials. So, you may have some litigations and some pending cases against the company which have not been disclosed in their financial statements. You may have, a couple of their top customers been complaining about quality, been complaining about ineffective service, and these might be significant customers who may be willing to leave. You may have instances where they have some pressing claims against them, again, not disclosed because you didn't ask for it, but these claims could materially result in something very catastrophic tomorrow. So, back in the days, I remember 2009, the Ranabaxi sale out. That was such a clever move back in the days, and both the brothers were commended, for selling out at the right time at a very significant number when the whole world was struggling for liquidity. 5 years, down the lane, the buyers came back and sued both the promoters, on a FDI complaint that was registered in the US, was not disclosed. The term sheet had significant representations and warranties built into it. And, this haunted the brothers to an extent that even till date, it's been a good 8-9 years that they haven't been able to come out of their mess. and they are still fighting over it. So, yeah, I think there's reputational due diligence, there's integrity checks one can do, and one has to go beyond the financials and beyond what is visible.
Thank you. What a lovely insight when investing into mid-sized profitable business, or if you are creating a mid-sized profitable business, these are the things that you should be careful about, because someone will come for you even after you sell, right? Then Bexy like, same. I would like to take this to Sinchana. I'll share you one incident also very quick. So a business approached us. Now they started like 30 years ago, okay, earning humble profits in Delhi, approx 60 lakhs to 1 CR every year. In last 2 years, they received a GST notice, which challenged their whole this structure. Now that business has nothing to give to his son. And as of today, when I talk to that guy, he's like, I am exhausted. I am burned out. I just want to close this company and I want my son to start fresh or to do a job, not do business. But to Sinchana, do you think founders burnout is a thing? And do you realize that investors, the people who are acquiring us, realize that this founder is burned out? So we might pressure him for lower valuation, or we might take some added advantage. How do you see this, founders burnout?
Right. So in India, all of the business families have been running profitable businesses for a long time, and none of them have complained about burning out. So why has this issue become so prominent now? Is it only because of investors, or is there more to it? So a lot of people ask me if investors actually put in a lot of pressure. I love answering this question. So basically what happens is, when you are an early stage investor, the only thing that you can look out from a company while making the valuation claims or investing is the asymmetric risk to return ratio. That is all the positive signals that we can get from the market. We can do all the market research in the world, but everything again boils down to the founder's credibility and the founder's experience and how the founder has executed in the past. So initially that is the case, but going forward, when the company has more and more investors on the table, has some cash flow in, they need to build in a structure, they need to hire the team well, and they need to bring in more and more compliance in the place and make the company foolproof. So that is one of the way in order to make, when the company becomes big, we can ensure that there is less burnout among the founders. The founder himself has been portrayed as stars with a lot of television shows coming up like Shark Tank and others. It's been a very positive impact, but it has also impacted negatively to the founders, wherein they start thinking that they are equivalent to the company. They are a part of the company, but they are not the whole company. Initially, yes, but going forward, they need to bring that image down. So with a lot of social media also coming into place, founders 30 under 30, LinkedIn post, all of these glamours that comes with the title founder, I think adds on to a lot of pressure. This gets into the head of a lot of founders who are not experienced, who do not have a lot of their number twos in place. This is a real issue, and I don't think investor is the only problem here. I think the society in general, all of the social norms that the founder himself puts, I think has a greater impact to it. But a lot of turnaround stories have also come in. Ben Hollowoods is one of the most famous investor today, but then when he was running his previous company, there was a lot of severe burnout cases, a lot of depression that he was into when he had to lay off a lot of his employees. But he turned that out, and when he became a second-time founder, he did not repeat all of those mistakes. I think learned from his mistakes and came forward. But mental health awareness is great today, and I think founders themselves should become aware of the fact that working lot of 80 hours a week is not going to be sustainable on a longer run, and need to hire some coaches, and some have to have some in their personal life also should keep their compliance well and not just professional work.
Yeah, please, Sreepriya.
I think Sanchana, you really explained it very well. I can clearly understand. So while we are also talking to many founders for investment purpose, right? So this is something which commonly comes up, and that the founder sometimes loses the focus, sometimes is not having the fire which was there earlier. So as an investor, when we review, we see that often. So I think one of the things which founders should also do is look for support systems outside. Not necessary you need to build everything in-house. You can have your core business, what is very relevant for you to day-to-day basis, look at, you can have it inside. And there are many structures which are outside, like a VCFO, virtual CFO, which is possible if your finance function can be outsourced. Maybe, I'm not saying for every company it's the same. HR activity, marketing activity, especially digital marketing. You have firms which can do it, and you just need to review the senior person of that firm or the founder of that marketing firm, founder of that VCFO firm. So that will liberate a lot of your mind space, a lot of your time as a founder. And that's extremely important. And these has to be considered as your investment. Because for you, what you need is time. As a founder, what you need is time, which cannot be earned again. Once you spend it, it's over. But what you need is, you need such partners who will take care of all of this. And another beautiful point here again is, when you're collaborating with a strategic partner for doing any of these functions, they also come with a lot of experience of dealing with other founders. So in many times, the conversation helps. When you're interacting with a VCFO partner, the VCFO comes with that experience of interacting with other founders. So they will, invariably it will come up in your discussion, whether it is positive or negative. Same way, a digital marketing partner, he or she, the digital marketing partner firm, will definitely talk to you about the other good things. What are the latest technology? What kind of an AI mechanisms they are doing for, faster churn or faster outcome of certain design and all of that. So it is really helpful. I think founders should need to look at what can be outsourced and how much can be outsourced. Of course, keeping the balance and control with the founder, at least till a particular stage. Yeah.
Beautifully added, Sreepriya, and lovely answer, Sinchana. Basically, I recommend a book on this, The 4-Hour Work Week. Or if you are a modern person, you should find your own David Goggins, who keeps pushing you, stay hard, stay hard, stay hard, and then you keep taking that final lap. Now, as we have time up, but forget everything, forget the outside world. The people who are here today, that matters. You independently tell that what is that one thing everyone here or everyone here listening can come up to you for, and you are that, I'll root for you.
Okay, if I can go first. I think I always tell the founders that if you plan to fail, you will fail to plan. Sorry, if you fail to plan, you will plan to fail. So I can help these founders to plan.
Lovely. Pankaj.
Get board advisors, get strategic, thought process, get some outside thinking which will make you uncomfortable. It's when you're, challenged, you build muscle.
Superb. Sinchana.
So please come to me if you're thinking about building something. You don't really have to have an idea. You can just sit, we'll brainstorm, and I can give you a lot of industry insight as to what is happening.
Okay, what a lovely answers, guys. We started with exits, and now we are planning for your startup as well. Super. This is what the life is about, full circle. Any closing remarks that you would like to add, or anything you want to ask? Please feel free. Lovely. Silence means absolute yes. Okay. Thank you. Thank you so much, Sreepriya. Thank you so much, Pankaj. Thank you so much, Sinchana, for being part of this discussion. I'll give it over to the lovely lady here.